One of the many adverse consequences of 3 decades, or at least 2 decades, of easy money, that's quantitative easing, printing of money, the very, very low nominal and at times negative real interest rates, has been that these permanent stimuli have delivered to us lots and lots of zombie companies. Now, you might wonder, well, what has a zombie company got to do with monetary policy? Well, the answer is pretty straightforward. Essentially, as money is pumped into the system to keep the stimuli going, especially after the financial crisis in 2007, 2008, and during the COVID pandemic, the result has been that the money gets into the banking system. That's the point of it. And then that money, cheap debt for private equity in particular, but economic actors more generally, to then use to invest across the economies. The trouble is that what happened, certainly since the turn of the century, is that most of that money got deployed to buying up and mortgaging existing assets rather than new real investment. That in turn meant that companies that ought to have normally gone bankrupt and normally would have been part of the creative destruction process of capitalism in recessions were bailed out, and bailed out twice. Once because recessions were bought off by the kind of whatever it takes attitudes of central bankers, and secondly because the cash meant that the companies weren't really paying their cost of capital and therefore could remain on life support systems going forward. Now, the impacts can be seen widely across swathes of the private sector, indeed some of the public sector too. The number of zombie companies that exist in most of the developed countries has gone up a hell of a lot. There's a lot of the corporate sector which really shouldn't be functioning because it's not genuinely profitable. But we've put huge grits into the normal wheels of competitive forces, and it's no accident too that over this period the dominant companies have got bigger and bigger and bigger, and the route to buying up competitors and rivals has been easy because the easy money is there in the background. Now, why this matters in the utilities and infrastructure space is that it's here that easy money has had perhaps its most devastating impact. It's not just, the retailers, the supermarkets, the Boots and so on, which are lumbered with very, very high gearing, those mortgages which allowed the private equity raiders to pay out the dividends. But in the core utilities, there has been an episode of financial engineering over the last 20, 30 years, which is unique in economic history. The game in town was, and everybody understands this, to look at a series of privatized utilities and say, hey, these companies could carry a lot more debt. And instead of using the balance sheets to finance real investment going forward, which is what privatization was supposed to do, essentially they could be bought up with all that cheap money flowing through the banking system from the easy money, and then mortgaged to the hilt, and the results of those mortgaging activities could be paid out in special dividends and all sorts of other mechanisms. You can see it at Thames Water in its extreme, but it's true of Heathrow Airport, it's true of the distribution network companies, indeed it's true of almost all the unlisted privately owned utilities in the UK, quite a lot overseas too, and even the listed companies have expanded their debt on balance sheets independently of their investment, but at nothing like the scale. And so what we have is a set of utilities which are now extremely vulnerable to any and all shocks. And basically, we can either keep them going on life support systems or we can put them out of their misery. And if we think about the keeping them going story, well, in a company like Thames, what's really devastating is if real interest rates return to normal, as they have. In fact, they're higher than normal now. Real interest rates have been rising this year to high levels in historic terms and relative to economic growth. And although nominal interest rates might come down, inflation's fallen very quickly. And so those real interest rates look there to stick. So how are these zombie utilities going to be able to pay for all the interest that piles up as the costs of that debt rise because the era of easy money has eased back? One option is get the regulators to pay it. And indeed, that's pretty much what's happening. Another is to rely on implicit subsidies. So, for example, Thames asked that there should be a cap on fines because fining Thames undermined its financial viability going forward. It also asked for very large price increases to customers, again, to provide the cash to bail out the model that it's got in place. And that's what zombie companies do. An even bigger bailout would be if governments begun to worry about the sustainability of the corporate sector more generally and encourage central banks to get back in the business of producing yet more easy money. And indeed, in the UK, with the fiscal rules that the Treasury's adopted, leaky though they are, the practical way in which current expenditure might be kept down for the government is to have nominal and real interest rates low. And one way of doing that is to get that printing press back out again and encourage central banks to drop interest rates really quickly. Now, zombie companies are zombies in the sense they carry on perpetually or until eventually the plug is pulled because they're on these life support systems. And the scale is truly huge, and not least in the utility sector. But in the utility sector, the consequence of running a company at, say, 80% gearing and all the time trying to keep the business afloat is that the boardrooms of these companies spend much, if not most of their time, talking about how to pay the interest, talking to the debt owners, negotiating their financial position. They live as, if you like, the purpose of being the mechanism by which the interest is paid on the debt. And at crisis points, this becomes overwhelming. And so if you've got 80 or in one utility case, 95% gearing, that's what drives almost everything that the owners are concerned with, and that therefore is what drives the boards. An obsession with the finances rather than an obsession with what the customers actually want, with driving the investment programs going forward. Worse still, investment is at the margin under pressure to deliver the financial results. It's no accident, for example, that Openreach is now thinking about winding back on its investment program because it can exploit the market share it's built up, and more investment pressurizes BT, and BT, of course, has been a financial, not quite wreck, but a company in financial difficulty for a considerable period of time, particularly in its case with the pension fund that hangs around its neck, or the pension deficits. So boardrooms get preoccupied not with the questions that really matter for the economy, investment, customer service, excellence, and all the things that we might expect, but they get focused on the wrong things. And what goes is investment, capital expenditure, and particularly longer term capital expenditure. And of course, R&D goes out the door. And again, look at the water industry and see what privatisation has done to R&D. It's basically stopped. And that's because at any reasonable discount rate, and particularly if you're husbanding cash for your existing debt owners, why would you spend the money on activities which might not pay off for 10, 15 years into the future? And this then is serious. And it leads through to the observation that it's really not surprising that productivity growth in the utility sector is very low. There are many people who argue that productivity growth more generally in developed economies is explained in part by this burden of zombie companies out there not in the position to do the technical innovation which drives growth and drives productivity going forward. So we pay an economy-wide cost for zombie utilities, as well as a customer cost and an investment cost in these core activities. Therefore, next time you hear someone suggest that, well, let's do a little bit of a bailout here and a bailout there and a bit of government money here and a bit of government money there, remember, it's not just the short term that gets bailed out, but it's the medium and longer term economic growth potentials of the economy which get seriously damaged. And of course, the utility infrastructures are the core backbone through which competitive forces operate. They're how individuals get access to society and the economy, and they're how companies get their goods to market and their workers to the office. So, big consequences. So what should we do? Well, rather than kick the can down the road, this should be one of the very high items on the new Dash for Growth agenda, which the UK government has, and the previous government actually had, and lots of governments in the developed world have too. If you want economic growth, you can't have the millstone of loads of zombie companies around your neck. You have to face up to the consequences and put them out of their misery. Fortunately, in the utility sector, we have exactly the mechanism to do that. And that's special administration. Special administration means that we pull the plug on these zombies. We get the administrator to take control of the businesses, and then we restructure the businesses and sell them on to new owners with reasonable balance sheets and without the unsustainable debt that's been piled up. That's what we should do. That's the consequence. Things can get worse before they get better if you're actually serious about economic growth. Economic growth means hard decisions. It means, in this case, putting the zombies out of their misery. And then we can look forward the development of these new infrastructures into the future after this initial cathartic experience. And of course, we should start with Thames. There will be casualties. It's true that the debt holders will have to take a big haircut. So they should. This is easy money that did this, and there's no more easy money out there at the moment to do more, unless, of course, governments fall back on the printing press again and try to resort again to permanent stimulus mode. So more productivity, more investment, better customer service, boards focused on their customers and the business, not on endless debt negotiations. What's not to like about that? Well, the answer is the pain of getting from here to there. But if we're serious about change, serious about turning the British economy around, this has to be done now, quickly, and no more kicking the can down the road. Thank you.